let's move back to the balance sheet. Now what I'll do is I will just bring the numbers that I forecasted. Equity capital 80,000. Unfortunately, it is the same because we are not able to forecast these two things, which is a reality because don't forecast things unnecessarily, which things which are not possible, let's keep it flat. That's the rule. Then we have the retained earnings, which is obviously we are able to forecast 149, 211, and so on. So that will be your retained earnings. Then you can just drag it because this is just a summation of these two things. You can keep it blank because this is already forecasted as a clubbed figure. If you remember that this is a summation, right, of these two, which is being forecasted like this, right? So this is done. Now, equity we have completed. Now, what we can do is maybe you can just not complete this portion right now. You can do it later on. If you have done it, whatever you have done, it is fine. Whatever you have not, it is also fine. I'll just then move to the next schedule, which is your debt schedule, right? So debt schedule is basically same, copy the header, paste it in B3 cell and put debt schedule. So in the debt schedule, we have two types of debt. One is short term, one is long term. So we'll be doing both. Firstly, start with the long term debt because short term debt is anyways we don't have. We'll just be doing it for the sake of it. Main is your long term debt because you do have long term debt. So in the debt schedule, you will say long term debt opening and long term debt closing. And then you have issuance, as I same for equity, that if you raise more debt, it will be added and you can do repayment because eventually you have to do the repayment of debt also. So this will be long-term debt 9923. So these long-term debt will be this. As always, the closing when will be the opening of next year, right? And then we have issuance and repayment, which we will see if we can forecast or not. So this also will be dragging it. Now, issuance is still very difficult even for the debt also to forecast unless company provides an idea that they are planning for some M&A or something, then we can somehow forecast. But for repayment, yes, we can do the repayment check that what kind of repayment plans they are having. So for that, you need to do the searching of 28,000 money, which is your long-term debt. So I'll copy and search. Please do search and give me the breakdown of 28,826. In which page you find this breakdown 28,000, 826. Anyone who get the breakdown of this?
Page number 110.
Page number 110. Okay. Yeah. Yes. So I got it in the page number 110 only, which is your long-term debt, right? And the total value is 28,826. So this is a breakdown that we have three types of debt, which is August 22 notes, May 23 notes, and August 24 notes, correct? Total value is 10,000, 8,500, and 10,500. Now look at this thing. Total debt was 29,000. But the balance sheet value is 28,826. Can you tell me why there is a difference of this 29,000 of total debt is only 28,826 in the balance sheet? What is this 174?
They might have paid excess tax prior
No.
or any kind of like discount on their depreciation.
Insurance cost.
So basically, this is not a tax or something. This is an amortized discounted issuance cost, means that either it is an issuance cost. So suppose if you raise a debt in today's time, whether you raise a home loan or something else, suppose you're raising a 1 crore of debt, in your account you only get 99 lakhs, say 99 lakh 5,000, 500, 5,000 or something. Why? Because there is always a processing fees or a issuance cost. So that they are deducting. So that is your 174. Second is unamortized discount is basically similar to if you give a bond. So this is all what corporate bonds that they must have issued to the general public. So agar if one bond is worth 1,000, they might be giving it at some discount. So instead of 1,000, they will be giving it 995. So that discount also is coming here. So largely it is issuance cost and some discounts that you may have given while investment. So actual money is this. So that's the reason why it is actual has been included. Is that clear?
Yes, sir.
Yes, sir.
Now then, the thing is that you generally have future payment that you're planning to do. So in 25 and 26, no payment will be done. That's what you're saying. In 27, you are planning to pay 2750 of debt. So I will say 27 is this minus 2750 because this is a minus figure. And I'll keep it as blue. 28, how much it is? 1500. 29.
1,000.
And 24, 25 is 0 because they are not paying anything. So that is repayment is possible to do. One more thing, guys, very importantly, please look at my screen. If in case you don't find this schedule, still you can see and figure out the dividend payment. Suppose the maturity is happening in 2027, 28, and 29. The problem is that sometimes you have a clear understanding that when you will be doing a maturity. Maturity means you're paying it back. But the problem is they're giving a range 27 to 62 they will pay. So I'm not sure when they will pay. So if then I cannot proceed with the prepayment, then I have to look at this schedule only. But if in case this schedule is not there, the chances are they will give you a year of maturity. Suppose they say that we are going to pay in 2027. So I could have deducted 10,000 in 2027. Getting my point? Let's look at Amazon's annual report. Amazon annual report. Just for quick look how the debt schedule looks like for Amazon. So this is page number 34. I need to go to the balance sheet, which is this. And my total long-term debt is 67,150. This is my breakdown of debt. Here also, unfortunately, maturity is provided in range. But generally, you can get it in a single year. They also provide future principal payment. So if there is a range, probably you'll get that. If there is no range, you'll get a maturity. You can try for different companies. I'm pretty sure that you'll get a clarity this way, right? The second one is that it's also provide the interest rate that they're going to charge. So on 10,000 million, you're going to pay interest between 3.5 and 4.65. This is a very close range. You can take an average of this to get an interest rate, right? This is how your debt schedule will be covered. As of now,
What is the difference between stated and effective interest
yes,
rate?
for stated and effective, I can tell you the difference. If in case, look, listen to me very carefully. If in case you have a breakdown of 28,826, that what is the breakdown of 28,826 for August 22, May 23, and August 24? So, and if you use that breakdown, use effective rate. But if you have a breakdown of the full amount without issuance cost, so right now you just have a breakdown of 29,000, which does not include the 174. So then you have to take the stated rate. In other words, when you have the face amount of the breakdown, because you have the breakdown of the face amount, so you have to use the stated rate. When you have the net of amortization and issuance cost breakdown, you have to use the effective rate. Is that
Okay.
clear?
Yes, sir.
So what I will do is, firstly, I will just do this 0 for long-term debt. So long-term debt issuance, as I said, we are not going to forecast it because again, I don't know when the expansion of the company will happen or anything like that. But yes, I can forecast the interest expense because that is the next thing that we're going to forecast. Interest expenses, because you'll be paying interest to the debt holders and you can have interest income also. Interest income happens on which line item? Anyone? Interest expenses will be on long-term debt. Interest income happen on what?
On equities we are holding on other
Other
companies.
investments, yes. Income from non-operating activities.
No, or if we are holding
Some
bonds
interest
of other
will happen
companies.
on cash and marketable securities.
Okay.
I'm talking about only interest income. Equity will not have interest income. Equity will have capital appreciation and dividends receiving. But I'm here only just to ask what will be my interest income. So interest income can happen only two things. If you have marketable securities, short-term fixed deposits or something, or if you have the cash in your business, you can get some interest. So that will bring that later on. But right now we are just going to be, I'll be walking you through the interest expenses. Now for interest expenses, I know that my debt is 29,000 and I have to pay interest as this, and this. So I need this schedule in my Excel sheet. Either I just write everything down in my Excel sheet, which can be a little boring for me. So I have a solution to do so in a shortcut format. I can take a screenshot. I'll take the screenshot. Now it's a time to do some automation, bringing the same data in seconds to the Excel sheet rather than writing everything down. So I can just save this screenshot, or you can take a photo of this screenshot with your phone, or you have a snipping tool as a software in your laptop. Snipping tool is a Microsoft, I think, software which can take a snap of anything. So I've just saved it. Now what I'll do is, if you have the latest version of Excel, you can use some automation work, go to data. If you don't have, just do the manual punching. That's the only thing I can suggest. So I have an option, picture from file, means I have to take from picture, I'll take a data. And otherwise, if you don't have that option, you can go to get data, go to file, go to the PDF, upload the full annual report, and then give the page number, which is this page number is 110. So under 110, you will get the data in Excel. You can try that. I think you should know some automation, also smaller automation to get the data, fetch the data. But right now I'm going to use the picture. So I'll select picture from file. I'll get an option to choose the the image from which I need a data from. So if you remember, I already saved that picture that I took under download option. This is my screenshot that I used, and I'll say then insert. The moment I do insert, Excel will do the work for me, data from picture. It is processing the data. You can review the data before you put it in Excel, but I know that the data is correct, but you should be checking it every time. Either you insert the data and then check, insert anyway, and then I can quickly check if the data is correct or not, right? Then what I'll do is, I don't need this unamortized discount or anything. The data which is not needed should be deleted. I don't need this, I don't need this, I don't need this smaller dollar wala line items. I don't need the effective rate because I'm going to use the stated rate. So this is the data that I needed. Now there is a problem with this data. It is not completely ready to be used. So you see that when I do a percentage, you need to just remove that. No, sorry, it is what 3.5 to 4.65. So they are unfortunately split it into two cells, which is not right. So what I'll do is I'll just cut it and I'll put it like this. So guys, since I have two interest ranges, the problem is that which interest to select, this or this. So the only way you can do is average of these two is the best option that you can do. So I will say is equal to average formula, and I'll keep these two numbers within the brackets to get an average 4.8. Same way I have to do this average.
Sir, instead of taking a screenshot, you also showed another method. So can you show that again? How to get data from PDF?
From PDF, yes, I can do, but it will take some time. I mean, it takes some processing time. I will not do hit process, but I can show you quickly. So let's go to data, go to get data. There are multiple options, so many options. Those who can get an expertise, just try everything. You'll get to know everything. Excel to Excel, you can do Excel to text, Excel to SME, Excel to JSON, Excel to folder, Excel to PDF. So I'll do Excel to PDF, which is very frequently used option in Excel. So once I do so, it is asking me for the which PDF you want to use. So I'll go to the download option. I have a lot of PDF there. So suppose I have annual report 24. I will import it and it will do a lot of Excel work. Means what will happen is there will be a dialog box which will give you an index after a lot of processing that you need a data from which page. You can select that page and then the full data will be there. You can just need to insert and the full data will come. Are you getting my point?
Okay, sir.
So you can do it. If you have any issues, we can discuss it in the next class because it will hang my Excel. That's the reason I'm not doing it right now.
Okay, sir.
Right. So okay, so now what we will do is to calculate expense, you need to calculate like this. Look at my screen. You are paying 4% on 10,000, 4% interest rate on 10,000. So you're actually paying an interest of 408. So on, you're paying this much of interest. Total interest you're paying is 1365. This is the interest payment on an average. So your interest rate would be, can we say 1365 you are paying on 29,000, which is a single weighted average interest rate that you have calculated, which is this. And you can just keep it as green. So this is your average interest rate payment, correct? So how will you calculate the interest expenses for your company is equal to sum. You will have to pay interest on the opening balance, and if you raise any new debt by any chance, this is the total amount you'll pay interest on into you'll pay interest of 4.7. So this will be your interest. You have to freeze the interest rate thing and drag it. So this is your interest 13, 13, 13, 1200, 1100. Correct?
Yeah, but during the period, if we repay any principal amount, then we won't pay any interest on that, no, sir.
Yeah, so that is happening here. See, you paid 2700 and 1500, so that has decreased your debt to
Opening.
1000. So that is like, it is also reducing. So 3 years it's same, but on next year it has decreased because you paid 2750. Again, next year it decreased because you paid 1500 more. So it is actually working on the reduction,
Oh,
reducing balance. Clear? Now for interest income, I said I need to have cash and marketable securities to calculate the interest expense. Sorry, interest income, correct? So what I will do is, for that I need to forecast the cash. Then only I can do the calculation of interest income, correct? Because there is no cash as of now. So what I'll do is I'll go to cash flow statement. And firstly, I have to complete the cash flow to get a total cash. Then only I can calculate the interest. So I have successfully completed CFO or CFI, but I am left with the CFF. So for CFF, let's go one by one. Is equal to equity issuance. So equity issuance can be done from here, which is 0. Then equity repurchase. Equity repurchase is also 0. Dividend payment. So dividend payment, it is 5067. Then debt issuance. Debt issuance is 0. And debt repayment. Debt repayment is also 0. So you can just drag it. So you've got some forecast, which is 4067, 2750, 1500, 1000. Rest are 0. So then you will have to sum it up. So there will be a financing activity which is reducing your cash, means you are paying some financers, some dividends and interest payments. Now, what is your total cash flow increase for a particular year, which is CFO, CFI, and CFI. So one place you are, see, look at my screen. You are earning 67,000 of cash, out of which 45,000 are spending on your machines and 5,000 are spending on your dividend and interest payment. So I left with only 16,000 of cash because you paid certain amount to certain people. And last year of cash was how much? Ending balance of 24, which you can get it from balance sheet. Your last year cash balance was 43,000, which is the opening of next year, because last year closing is on opening. Then you also earn 16,000 this year. So your total cash turns out to be 43,000 last year and 16,000 this year. So this has increased to 60,000. And if you try to forecast it for the next 5 years, your cash is increasing 60, 88, 119, 158, and 205. So this completes your cash flow statement too. Right? Any question till this stage?
no, sir.
No, sir.
No questions? Now, what we can do is we can bring the long-term debt here. Look at my screen. The long-term debt needs to be filled. So this is your non-long-term debt. Cash flow is ready. Only short-term debt is left, which is already 0. So it doesn't make any difference. So I'll do it later on still. Next is your interest. So interest is the time to when you pull the interest from the debt schedule. Just give me a minute. Is equal to, can I get the interest from here? But for that, just a minute. I am sorry for the confusion. So basically we'll have to calculate the
Income also.
net interest expense or income. I don't know what will happen. So for that, we need to calculate the interest income. Let's do interest income. So guys, generally for interest income, we don't do much of a hard work that how much interest we are expecting or getting. Generally, that information is generally not provided in annual report. So I'm expecting a very simple interest of 0.5. Generally, most of the models will be having an interest rate income of 0.25 to 0.5. So what I'll do is equal to my ending cash balance is 60,000 into my interest on that cash balance is 0.5. So I'm getting an interest of this. Is that okay? So you are actually getting a 0.5 interest on your cash that you have, which is 60,000, which is taken from your cash total. And your net interest expenses, you're still having an expense of 1,913,758,434 and 127. Now this will go to your
Income
this
statement.
place is equal to 1053. Now the moment you do so, you'll have an error. This is the error that you will have, which is called circular reference. You see the circular reference is mentioned here. Circular reference. Say okay. The data will not come. This is a zero figure because there is an error. Now, what is this error? This error is such that suppose you have three variables A, B, C. What is happening in this error is basically when you have this interest wala error, that A is dependent upon B, B is dependent upon C, and C is dependent upon A. So if you have that situation, you cannot calculate mathematically. So algebra, if you are aware of a bit of 7th, 8th standard maths, where there are suppose three variables X, Y, Z or A, B, C. I say A is based on the value of B. B is based in the value of C. C is based in value of A. So there will be a circular rounder reference. Everyone is getting this point? There is no independent variable, guys. Every variable is dependent on each other. And for an equation to solve, you should have at least one independent variable. Do you agree with me, Kanak, Mr. Nallu, Priyanshu,
Sir.
Rochin, and Somil?
Yes, sir.
Yes,
So
sir.
this Excel is
Yes,
having
sir.
this issue. And the only way to break this issue is to get a trial and error method. Trial and error method is just assume A is 1, then what will happen to the remaining data. So for that, that's the reason why you're getting an error. And to overcome that error, Excel has a very good option, which is I'll go to File, then I'll go to Options. When I go to Options, I will go to Formulas, and I have this iterative calculation. I will just check box this, right? And say okay. The moment I say okay, this trial and error will go away. And I have my numbers. The same numbers that I had it here. But the problem is that every time you save this file, there will be a very small change in these numbers. Look at these numbers 1, 2, 3, 4, 5. And I'm going to hit save and see if there are any errors, changes. There will be changes. Again, there is a last change. So there may be some changes, very slight, because Excel has to recalculate the moment I hit save. But the problem is solved. That's the important thing. So now I have everything with me. All the line items of income statement are ready. Balance sheet, the cash is left. So I'll just bring the cash closing, which is 60,000 or 59,000. So that has come here, 59, and drag. So only debt is left, but the problem is that debt is already zero. So it should not impact model, but I will forecast the short-term debt also. And we can check if the balance sheet is matching or not. So the total asset I have is 322450, sorry, comma, the liability is the similar looks like. So there is no difference. It means that my balance sheet is matching now. So this is how you have to match the balance sheet. Is still coming, like 4 are coming true. One is coming false, maybe because it is a decimal difference, 0.000001. So if you keep saving, it will come true in few minutes. So I'll keep on hitting save. So you can just maybe avoid it, but it will come true in after some iterations because the difference is almost zero. So don't need to worry about that. Right? So that's about your model matching and debt schedule, which is long term. We are still left with the short term debt.